When it comes to pensions, reaching age 75 is an important milestone, and for many of you, this is a vital time. It is important to plan for this event in advance, and this is because changes in tax relief and the taxation of death benefits after age 75, as well as the potential lifetime allowance tax charge which could apply at age 75. Since 2011, it's no longer necessary to crystallise your pension benefits at age 75. So it is possible to remain uncrystallised beyond age 75. And the right to tax-free cash, or PCLS, remains. PCLS is pension commencement lump sum. So reaching age 75 is an important time to discuss any trusts that you may have set up to receive death benefits. This is because on death after age 75, your pension provider will deduct a tax charge of 45% from any funds paid to the trust and pass this on to the HMRC. So I'm going to discuss the pros and cons of trusts after age 75 in future videos. I'm going to begin with some information on the differences in tax relief, death benefits, and how trusts operate before and after age 75, as well as how the lifetime allowance and benefit commencement events, BCEs, operate at age 75. In future videos, I'll go on to consider some case studies to bring these aspects to life. Most of my examples will be dealing with individuals who are members of personal pension schemes, as I expect most members of defined benefit schemes to have taken their benefits at their normal pension age, which is earlier than 75. Pension flexibility brought in many changes, and one of the biggest was the change to taxation of death benefits. Although reaching age 75 isn't the cliff edge it used to be for pensions, it is still vital that you understand what the implications are at this time. So, personal pensions, tax relief before and after age 75. So we've got individual contributions and employer contributions to consider. So before age 75, any individual contributions are paid net of basic rate tax and are grossed up by your pension provider. Most pension providers credit this basic rate relief immediately, and any higher or additional rate relief can be claimed by yourselves through your tax return. Contributions not entitled to tax relief aren't accepted by many pension providers, as this would require their systems to operate two different methods. After age 75, no tax relief is added to individual contributions, so many providers won't accept individual contributions after age 75. So for most people, pension funding will stop before or at age 75. Any employer contributions are paid gross before the deduction of corporation tax. So, subject to the rule which is called the wholly exclusively rule, employer contributions are in theory unlimited, although of course you could face an annual allowance tax charge if you exceeded your available annual allowance. Employer contributions do not need to stop at age 75 and can continue to benefit from corporation tax relief, provided the wholly and exclusively rule applies. But not all providers will allow contributions to be paid after age 75, including employer contributions. Individuals working beyond age 75 will need to consider your pension funding options, as it's likely that your individual contributions will stop. If your provider allows it, employer contributions might still be possible. If that is the case, salary sacrifice might be worth considering at that time if it hasn't been already. In future videos, I'm going to talk about lifetime allowance protection, how BCE, that's Benefit Commencement Event 5A, and Benefit Commencement Event 5B works, along with taxation of death benefits and inheritance tax. I'll do a video on trusts to receive your death benefits and taking withdrawals to reduce your lifetime allowance charge. So please obviously subscribe so you get notified of when I put those videos out. And of course, if you've enjoyed this video, please press the like button now. I really do appreciate it, and it does help my channel. Thanks so much for watching. I'm Justin King. I'm a chartered and certified financial planner. I'm also the host of a podcast called the Retirement Cafe Podcast. And we have a weekly newsletter full of retirement tips if you'd like to subscribe. There is a link below the video for all the details of that. So thanks for taking your time to watch, and I look forward to talking again with you soon.